Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right. Well, I'm excited about our next guest, Nick Andromidas. And Nick, welcome to the show.
Keith, welcome. I'm glad I'm here, and I appreciate you inviting me onto your show.
Yeah, you've got an extensive background, Nick, and I'm excited to unpack everything that you're in as far as your investments. Our audience, oftentimes they're familiar with the 401k. When they think real estate investing or investing in hard assets, they don't necessarily, think some of the things that I know, we're going to hear about on this show. So I'm excited about it and looking forward to sharing your story. I'll tell you what, though, why don't we start kind of from the beginning? If you'll tell us a little bit of your background and kind of how you got started, go from there.
I'll do my best. I hate talking about myself, but I mean, I'll give the cliff notes on what's going on here. So I'm originally from born and raised up in Canada. I came out to the States in 1995. I came in through the trade, through the North American Free Trade Agreement. I just came in as an economist, hired a lawyer to get, come in legally. And I ended up in the film industry out in LA, lived there for 24 years and spent about 13 years with Sony Pictures. And through there, that's how I had my W-2. Just a regular W-2 job, worked my way up. And while I was doing that, I realized that there's no way I'm going to do this for the rest of my life. So I started investing in real estate. And I started buying condominiums up in Toronto. Being originally from Canada, I had the connections there. Flipped a few homes out in LA with a bunch of other guys, but it just wasn't penciling out. It wasn't worth my time or their time. So that didn't work out, and that's how I got into apartments. So I couldn't scale up on the condominium side, only because Canada, even though I'm a citizen born and raised, I'm a non-resident for tax purposes. So I couldn't scale up. It was hard to get financing. I had to set up all sorts of companies, and then the tax rates are just ridiculous up there. So that's how I got into apartments, multifamily, and I started investing as an LP.
And Nick, on that, isn't there just in knowing you a little bit, wasn't there some tax? I know you mentioned taxes up there, but they hold some of your money or something. I mean, most people aren't familiar with that, just because unless they're Canadian. But
yeah, I'll go through that real quick. That's a great question. So I'm assuming IRS does the same thing for non-residents, right? Because they don't want you to cash out, and then how are they going to come after you, right? So the way it works is when I sold my properties up in Toronto, the lawyer had to hold back 25% of the gross. So let's say it's a $400,000 sale. He's holding back $100,000. I then have to fill out a disposition form with the Canadian Revenue Agency, right, to tell them that this is the amount of tax I owe you. So I owe you I'm going to owe you $60,000, right? I send that paperwork in, they review it, they either accept it or they don't. If they accept it, they send me a certificate of disposition, which then I send to the lawyer, which tells him, send $40,000 to me and $60,000 to the Canadian Revenue Agency. So that takes a couple of months, right? Now they have $60,000. Now when I fill the normal income tax returns, where I can deduct the real estate agent commissions, all these costs, to lower my 60 down to, you end up paying about, in Canada, I think it runs about 25-30%.
Okay.
So
is it like a capital gains type tax, or
it's a sort of capital gains? And because you're a non-resident, they even put more on. And I've kind of raised my voice at some of the agents. It's like I don't even get free Medicare from you guys. Why am I paying for all these taxes? I mean, it was a waste of my time. But anyways, so that's another reason why I don't invest in Canada yet. It's just really tax heavy. Again, it could be that I'm ignorant and I don't know any of the gray area and know all the tax laws like I do in the U.S.
Sure.
But I just decided also it's just far away, and it became crazy. Yeah, it's just like everywhere else. The pricing went really, really high, and I sold out I was lucky at the right time, and sold my last property back in June of 2020. 2021, sorry. Yeah. So I'm completely out of Canada. Everything's here in the U.S., and that's why I got into multifamily, because I just wanted to scale up. So I started investing as an LP, as a limited partner. A bunch of guys asked me to be a KP on the deal that they had. A KP is a key principal, right? They used me for my net worth. And then through there, asked lots of questions. What are you guys doing with this? Why did the financials read this way? They saw that I brought value when it comes to the financing part, the operations, the reporting, and
the underwriting.
They asked me, the underwriting as well.
Nick's for knows that know him know he's really, really great with the numbers. So
I just have the eye for it, and it's just that it's a natural knack that I have, that if the numbers don't feel right, I dig in. So yeah, and that's how I got into a deal where I'm a GP now out in Abilene, and the property's doing really, really well. Man, we didn't get bridge debt, which thank God, we got fixed rate,
right?
And we're paying out. I'm projecting out for this year, for 2023, to pay out about a 12% return.
Nice.
We didn't do so hot during COVID. We held back. We did pay out once in 2021. There was about a year we went without, but we just wanted to be liquid, right? We didn't know what was going to happen.
Sure.
But we never defaulted. We never had any issues with our lender or anything like that. And now we're just coasting. We got we changed property management. We got a great manager, and we're just doing really well. So it's a good deal.
Yeah,
we can talk about that later too, if you want.
Exactly. Yeah. And how many units is that one?
That's 228 units out in Abilene.
Okay. Yeah, nice.
And I'm invested in another about 1,400 units as an LP. I've gone full cycle on 6 properties as an LP. Two of them, the best one paid me out 2.8 multiple. Second best, I think it was 2.1, and then everything else was like 1.8, 1.7, 1.3, 1.5 multiple. And then I took that and I invested in a hotel that's being developed down in San Antonio on the Riverwalk. And I've also invested, and I've invested in it's a 2-part play. It's a real estate restaurant deal. I grew up in the restaurants, love the restaurant business, and it's blood money. It's not easy work, but I felt I knew the guys, the operators, and it's a deal where it's a real estate play and a restaurant play. So I'm curious to see how that's gonna go out. They just got their permits a couple of weeks ago, so hopefully by the fall they'll be open and running.
Oh, that'll be great. Yeah, I'm excited to see that. I live obviously in San Antonio. That's with Jake Harris and
Jake Harris. Yeah, great
Okay.
guy.
Yeah.
Great. Yeah.
Cool.
Keep our fingers crossed.
Yeah. I'm sure it'll be good, man. The Riverwalk just continues. With the stuff that maybe people don't see from the outside of San Antonio is just there's so much investment right now in the Riverwalk, both from the city and just investors, and it has changed. I mean, I over the last 10 years, it really has changed significantly. There's the little stretch that most people hang out on for the bars and all that, and maybe that has not changed quite as dramatically as the rest, but it has been extended, and so I think it's going to be continue to draw visitors, and should be good for you. So
yeah, that deal, and just so your listeners know, I'm not familiar with the Riverwalk. I mean, I'm familiar with the Riverwalk. I don't know it. I'm not an expert on the Riverwalk. I've been to the Riverwalk twice in my life. But because I know of the area, and I know it's a tourist attraction, but I'm really betting on the jockey, right?
Yeah.
I know the jockey. I know Jake. He's a great guy. So that's the main reason. I mean, yeah, if it was somewhere else in a shady area and I knew about it, I'd think twice about it. But because it's the Riverwalk and it's mostly Jake that I'm investing in, so
yeah. Makes total sense.
Yeah, everybody should get to know. Yeah, everybody should get to know their sponsors or their promoters or whatever you want to call them. But yeah, syndicators.
Yeah, maybe now would be a good time to just talk a little bit about that. How do you vet operators? Obviously, you're an operator yourself. All right, you're a GP yourself on some deals, and I know you're actively always looking for your next opportunity. But when you have been just as active, if not more, in other people's deals and as a limited partner. And, what do you look for? Obviously, as you said, you're betting on the jockey. So, the horse has to be in good shape as well. The numbers need to make sense, but ultimately, it's just a theoretical plan. If you look at a property and say, here's what we're going to do with it, and somebody has to take that plan from the drawing to fruition.
So when you're looking at a deal, you're looking at a track record. How many deals have they closed? Now, they don't need to have done 10 deals, right? First of all, you should know them, right? It's that triangle of you have to know someone, then you have to like them, and then from like you get to trust them, right? If they've done 2 or 3 deals and they've got that they're good, the most important thing is that they understand a P&L, a balance sheet, right? Economics. There's a lot of people out there that don't even know how to read a P&L, believe it or not. They think
Right.
that the property manager is going to do everything. As long as they've got the background, whether they were in a different career, whether it was a corporate position, they could have been a CFO, an engineer, right? As long as they understand profit and loss, income statements, balance sheets, right? Cash projections, because that's what you're managing as an operator. You're not managing the day-to-day. You're not managing the leasing, but you're managing the property manager by looking at their reports and their numbers and saying, why aren't you, why was there only 1 lease signed this week when you should be signing a minimum of three leases a week, right? One of the hardest things I'm having that I'm trying to work on with property management companies is, hey, let's spend $3,000 a month on marketing. All right, well, can you give me what happened with that $3,000, right? And they can never get me the information that I want. So I can say, are we spending $3,000? I mean, I think it's working. I mean, when it comes to the data, I don't have 100% of the data that I want, but the data that I have access to, I could see that it is working because we're running between 94 and 96% occupancy. It drops here and there, but every other week. But that's the range we're staying is between 94 and 96. So could I do better? Yeah, I'm trying to figure that out, right? So that it's dialed in on marketing. And then you just look at the expense ratios, right? You pull the profit and loss every month. You've got your ratios, and you see where is it heading? Is are the expenses staying within 47, 48% of total rental coming in or whatever. Some properties might be down at 40%. Some properties might be at 55, depending if they just started out, right? If they're trying to stabilize it. And those are the numbers that you need to keep looking at, because you have a fiduciary right to your investors, right? You can't just sit back and do nothing. That's the asset manager's job. And unless a sponsor has hired an asset manager, that's their responsibility, right? So I don't know if I answered that question, but yeah, that's how you vet a sponsor. His track record, their background, and if they're spitting out, we're going to do 10% a month in rental increases. Yeah, maybe back in 2020, 2021,
right?
It's not happening anymore. I mean, things are starting to tighten up.
I was going to ask you a little bit about that. Obviously, in some of the deals, for all the deals, right? Everybody was projecting rent increases into their underwriting, and what on the deals that you're looking at now, what are you projecting as far as rent increases? And maybe a follow up to that is, what are you looking for? Where are you looking for opportunity to add value?
So the first thing I'm looking for is something that's mismanaged.
Right.
Are the operators absentee owners, right? Are they the type that are just sitting by the beach and they think the property manager is going to do everything? There's a lot of that. I think now we're in a great opportunity time where you're going to see a lot of foreclosure. There's a lot of deals out there that have got bad debt on it and they can't keep up, right? It's a floating rate. And they won't be able to keep up. And then property taxes are going up. Insurance is just crazy, right? So they're going to get into a jam. What I'm looking for is something that's got added value. It depends, right? It could be added value. So, hey, can we upgrade half the units that are in there to get that $150 to $200 bump if the market allows you to do that, right? I'm not going to go into a market where people don't care about stainless steel and backsplashes. So added value, which are becoming a little bit harder to do only because there's so many units here in DFW. There's so many new builds coming up online this year. That's why I like the secondary and tertiary markets. And then also mismanaged, right? It could be an A class, it could be a B class. They did a great job. They upgraded everything, but they just mismanaged it. They had bad property management. They didn't take care of business. Like I said, looking at the reports every month and making sure that the PM is doing their job. Could be mismanaged. So those are the type of deals that I'm looking at. But more so now, like I said, I think foreclosures are starting to come up. But I try to get them before they get to the vultures, where like the other million people like me that are looking for deals. So
right.
We'll see what happens.
Yeah, no, that's perfect.
Another thing I want to throw in there, and there's a lot of people that don't, they don't, some people agree, some people don't, but the sponsor should have skin in the game. So, there's sponsors out there that take these huge fees, which is fine. I mean, they could have payroll, they've got an office to run, they've got expenses, but they have to have money, skin in the game. Because it's really easy. Think about it now, right? If someone can't make their debt payments and they've got nothing to lose, they'll just walk away from it. I mean, I'm seeing big institutions walking away from $32, $35 million deals, properties that are valued at $32, $35 million. They made their fees, they made their money over the years, and it's like, it doesn't fit in our portfolio, and they'll just, all right, fine, take us to foreclosure, we don't care. Yeah, but what about the investors' money? So it's we're going to be going through some tough times the next 9, 12, 18 months, if not sooner.
Yeah, and I think it'll be in a way similar to other times when we've had a downturn. There's going to be, obviously it's going to negatively affect a lot of people, right? But I think there'll also be a lot of opportunity out there for investors. I think there'll be a little bit of a reset. I don't know how you feel about that, but I'm hoping a little bit of a reset as far as pricing. It just started to get a little too nutty out there, where it was very hard to pencil anything out. But what are your general thoughts on that? What kind of time frame are you thinking. I know none of us have a crystal ball here, but
So right now there's a huge gap between what the bid ask price, right?
Right.
And you just have to, as a buyer, I just have to be patient. It's like, fine, I've put in a few LOIs and it's like, no, we're going to stay firm with our price. Great, good luck, right? And then Powell raises the interest rate another quarter. It just makes it harder for them, right?
All right.
I think it's already started. I saw something this morning. I'm sure, I don't know if you saw it as well. Arbor just foreclosed on 4 properties down in Houston. And I actually tried to get a deal out in Odessa, Texas from Arbor, and they were staying firm with their price. So you're seeing a lot of these lenders go into foreclosure because they're not going to take the risk, right? They can see that the operators are not going to be able to make the payment, especially if property taxes go up and insurance is going up like crazy.
Right.
And there was another deal. There's another deal that just went to the courthouse steps on Tuesday that was out in Midland. So it's starting. I mean, just right there, that's 6 properties within. I mean, let's say 5 properties within the last week, right? And then the Odessa one was like about 6 weeks ago. But it's starting, though, and those are the ones that I'm just seeing, right? Can you imagine all the other ones that I don't even know about? So I think it's starting, and it's just going to get worse and worse because people are like, I'm not going to buy. I mean, I'll buy something, but I'm not going to. If you want to hold your pricing that doesn't work out, that's fine. I know that there's another deal coming up, and it's just people are just kicking the can down the road. Some of them are getting mezzanine debt. Some of these deals, they're going and borrowing more money. You're just making it quicksand much thicker and harder to get out of.
Yeah. So that's a good point. And yeah, they're doing the mezzanine just to stay afloat, and so they're just adding more and more. Mezzanine is exactly what it sounds like. It's way up in the mezzanine. It's there's the first, there's maybe the second, and then there's mezzanine. So, and talk a little bit about that if you could. Obviously, you mentioned a minute ago when you're talking about operators getting in trouble and some of the bridge debt that is going to expire here, and they're going to have to refinance. What can you talk a little bit about that aspect of things and how that can affect? A deal?
I don't know the numbers specifically, like how what kind of debt's coming up this year, next year, and then 2025, but. The way it works is they're not, as interest rates go up, if they've got a cap rate, that's great, or a rate, not cap rate, but a rate cap, I think they're okay.
Yeah.
If they don't have a rate cap, it just keeps going up. So they can't make, it's going to get tougher and tougher to make that debt payment. And maybe they can make the debt payment and they're just not doing any distributions to the investor. But the problem is, let me add on, if property taxes go up, sure, you can protest it. But if you don't win the protest or you don't get them low enough, now you've got more expenses. And we all know, right? The 4 major expenses in multifamily is property taxes, insurance. It's 3, and payroll, right? Our payroll has gone up about 16%. And I'm okay with that. They're doing a great job and they deserve it. And, I'm not going to go too cheap because we did that in the beginning and it just hurt us. You get good people, they're gatekeepers on the property. But insurance quotes that I've been getting on these deals that I have been looking at, it's just ridiculous how much it is. Like some guys are quoting me $750, $800 a door.
Wow.
Right? When I first started, we're looking at $300, $350. It's like almost double.
Wow.
I mean, our property taxes last year went up 30%. We switched providers, still went up 30%. It's hard. So add that on to your debt going up, your property taxes going up. Rents are not going up that fast. People's income is not going up that fast. So it's going to get ugly.
Yeah. Well, like I said, opportunity though, right? For investors, you just gotta kind of keep some powder dry and be ready to ready to pounce on something.
Keep some the powder dry, and if you don't want to be an active and you want to be not an active but a passive investor, get to know as many syndicators as possible. Go out to the meetups, go out to the conferences. That's where they're all at. Get to know them, find out who they are, and if the other thing is, if they don't want to share their information with you, just walk away. There's plenty of people out there
for sure
that are doing this, and I think it's the tide is changing where these big institutions, and this is this is my opinion, right? Speculation opinion. I think this is a great opportunity for sponsors or syndicators that know what they're doing to build a family office. I mean, the family offices are just going to grow even more, right? Because they've got a lot more cash and they can scoop up these deals. But I think the institutions, a lot of people are going to get burnt by them,
right?
Like take for example that deal in Midland. The big institution didn't care, and they were big. They're like in one of the top 5. I mean, You hear about BlackRock, right? And they're not even paid. Their investors want their money back, and it's like, whoa, slow down. And they're only giving out, 2/3 of it or something like that, and they're giving it out slowly because they need to sell the property. Because if they all start selling the properties, that's where the price is which is okay for us, right? We don't mind that, but
right.
Just be. I think it's a great opportunity for us, the syndicators, and just vet your syndicators. Ask questions. I mean, don't just Google their name. Even ask for a background check. There's nothing wrong with that, right? Hey, I'd like to see a most recent background check. Nothing wrong with that. And if they don't want to give it to you, then you don't want to do business with it. Either they don't want to tell you, or they don't need your money, and you don't need their deal either. You can always find someone else.
Yeah, makes sense. On the deals, the various investments that you've done as a limited partner. Maybe kind of cover with the audience, if you would, just the difference between a limited partner and a general partner.
Very good, great question. So I'll start with the limited partner. A limited partner is just a passive investor. You like the deal, the sponsor, and it's what everybody calls mailbox money, right? I'm going to invest. They need some time to stabilize the property. And I'm hoping in 6 to 9 months, I start getting either a quarterly check, based on the performance that they sold us on, whether it's 6, 7, 8%. It might be a little bit too high nowadays, but 6, 7, 8% return. There's different investment strategies as LPs. I know some LPs that are just looking. They don't care about the cash flow. They need depreciation. Of course, everything's being sunset now. That 100% bonus depreciation is being sunsetted, but there's still enough what they call ghost money, right, or paper money to offset other passive incomes. That's what a limited partner is. You've got no voting rights. I mean, you could vote if the syndicate or asset manager is doing a really poor job. If you all get together, you can throw them out and bring in someone new to manage the asset. But it's basically you're sitting back and enjoying the returns on your investment. A GP, a general partner, is active. Depending on how many you have, I've seen GPs from 3 to 12. I think anything over 4 or 5 is a lot. And the GPs, they all have responsibilities, right? Some of them might be responsible for the monthly operations, dealing with the property manager. Another one might be responsible for a market rent or for the construction, or making sure, like, hey, are we at par with all the other properties around us? How are we staying competitive? So there's different roles that you can come up. That's why when I say anything more than 5, how many roles are you going to need? It's ridiculous, right? When you have 12 people on the GP, that's just, you're just asking for trouble, right? Too many cooks in the kitchen.
Right.
So that's the difference between LP is just a passive investor, mailbox money, and GP is you're actively involved. You're on calls every month, right? Once a week, every 2 weeks. It's not a daily thing, but you are you have to meet, or you should be meeting, at least once a week or every 2 weeks, to review what's going on with the property.
And in today's environment, if you're investing, say, in someone else's deal, what are you looking for? Are you looking for a preferred return? And what kind of a multiplier are you hoping to achieve?
So first, I don't invest in other multifamily deals because I like to keep the cash for my deals, but I do invest in deals that is not in my swim lane, like that restaurant, real estate play, or a hotel. That's not my swim lane, but I like to diversify. So I'll invest with the people that are, the experts in that.
On that hotel, and I'll let you finish answering your question, but on the hotel, one of the questions I was going to ask is just what kind of a project is that? How big of a deal is it?
It's a ground up. It's a boutique style hotel, and that's what drew me to it, because it's not your typical Hilton or NBC Suites or anything like that. It's a boutique hotel. There's going to be, and it's got a restaurant bar downstairs, which I think you're going to get a lot of foot traffic from the Riverwalk. But It's a boutique hotel where you're not going to be able to have 150 to 200 people. I don't believe 150 to 200 people. I could be wrong, but let's say there's no way you're going to have a 400 person conference there, right? It's a very you're going to have small groups having small meetings, small conferences, masterminds, let's say. And but the rooms are just immaculate, right? And it's not going to be $99 a night. It's going to be affordable to that type of demographic that stays at that hotel. So that's what I'm excited about.
Cool.
So yeah, that's the type of hotel. Back to the GP. I think we're talking about what's the difference between LP and GP. Yeah. I could have forgotten. Was there another question after that?
I was just asking on the, when you invest as a limited partner, whether it be multifamily or some of the others.
Oh, that's right.
What you're looking for from a financial standpoint.
So, and this is my take on it. There's no right or wrong answer. If you're going to get a preferred return, you're not getting any of the back end success, right? Because if the sponsor is guaranteeing 8% up front, then at the end, they're going to be taking 60% of the profit. And if it's a home run, you're going to miss out. Sure, you're guaranteed the 8%, but I'm looking for, nowadays, if it, I'm not sure if I can say I want, the bigger the multiple, the better, but things are tough now, right? It's crazy. It's like we said, with the pricing, it's hard. And there's only been 2 deals that I've gotten over a 2 multiple. But I'd like to be able to participate with the back end. If I trust and I know the jockey and I have faith in him and I know that they've got experience, it should be a home run at the end. And I want a piece of that action, right?
Yeah.
So, and then when you do preferred, you're just, I'm on top of the capital stack, but I personally, if I invest in a deal, I prefer that there is no because I like to get I'd like to participate on the back end. If I invest in a deal that's got preferred, then I can't do the preferred. I have to do another class of shares to get to participate in the back end. But that means there's someone else above me, right?
Getting
so
their money
we're all
first.
in it together, or we're not. Yeah. So I don't know. I haven't had to come across that because, like I said, I don't invest in other multifamily deals unless, I shouldn't say never, but right now I keep the powder for my deals because, like I said, I like to have skin in the game, so that my investors see that he's participating as well. He's investing.
Yeah. So on Curry Junction, the one of the ones that you currently have going, what is the exit strategy on that one? Is it going to be to refinance, to sell, or just don't know at this particular point in time? It may be too early in the game. And with the environment.
Our original plan was a 3 to 5 year hold, and then when we bought it in August of 2019, COVID hit in 20, right?
Sure.
And it just went bonkers. Right now, we are not. We'll sell if we get a crazy number, which I don't see that happening, right?
Yeah.
So if we can return, and this is a guy, we're projecting. There's no guarantees that we're going to pay out 12% this year. I mean, if I can continue, and our OI or IO runs out next year. Once we have to start paying the principal, our rents should be going up another 3%. Then when we have to start paying down the principal, it might go down to 10%. But at least now we're paying off the principal, right? We're building equity.
Right.
My objection is to protect and preserve the capital of our investors. So I'm not going to sell today when I know I can give them a better return, or projecting I can give them a better return later on, right? And the other question and conversation, questions I've received from my investors is, if you sell now, where the hell am I going to go?
Yes.
Where am I going to take my money, right? And today, with everything that's going on with the rates, there's no way we're going to be able to pay out what we put on our pro forma, right? Because the price, again, the sell and the price. So for now, we're looking at it on a quarterly basis, and we're reviewing it on a quarterly basis. But I think if the interest rates continue, if they stabilize, I'm hoping that they hold for the rest of the year. We'll see what happens. But right now, as of today, no, I would not want to sell.
Yeah,
because we've got a decent interest rate. It's fixed. It's way below where it is today, and we're doing well.
Yeah,
we finally got it to what's the word I'm looking for? But it's performing to where we want it to be. So it's great. Took us a little while, but we got there.
Enjoy the cash flow, enjoy it coming in, and
And we're doing monthly distributions.
Wow, that's great. That's great.
And April will be our 7th straight month. We did a few quarterlies before, right after the COVID, but we decided, let's start paying out monthly.
I like that.
It's just easy with technology now too. It doesn't take that long.
I know a lot of people prefer to do the quarterly, but I think for an investor, it's just nice, even if it's not a big check. If they're seeing something each month, then they know, hey, things must be going okay. So yeah, I think that's good.
So I'll share with you what we're doing is we pay out on a monthly basis, annualized at 8%, and then I true it up every quarter. So first of all, we've got like $100,000 in reserves. So we built it up and we said, look, we just want to keep $100,000 for an emergency.
Smart. Yeah.
So we've got the 100,000, and then every month we pay out based on 8% return annualized, and then every quarter, so March, June, September, and December, I'll hold back a little bit every month. So we'll transfer the money into our reserve account. We have an operations and we have a reserve account, and then in March, if nothing happened in January, February, March, as far as any unexpected expenses, we'll true it up to that 12%. For that 12, we'll add the holdback that I did in January and February. We'll pay it out in March. So in March, every quarter they get a bigger check, and that's how we're hoping to hit the 12%. I mean, so far we're on track to hit that, but it's only been 4 months.
Right. Yeah. No, it's a good strategy for sure.
Yeah.
Well, cool. And as far as other benefits, I don't know whether on the hotel or on any of your other investments, have you done any of the cost seg and bonus depreciation type stuff? And if so, if you don't mind telling the folks a little bit about
on
it.
the new deals. They haven't. I mean, like I said, the restaurant real estate play, they just got their permits maybe a month ago. Yeah, it's an existing restaurant. They bought the land and the restaurant, but they have to gut out. But it took months to get the permits. So they just started work. I think I saw the dumpster out there like 3.5 weeks ago.
Okay.
And then the hotel, I haven't gone down there, no, but they're still progressing. And I mean, that's a 2-year wait. So I haven't been paying that much attention, only because I know it's a 2-year thing. I haven't received any information. If I did, maybe I missed it. But no, they haven't done any cost seg. But from the projections that I got on the hotel, the cost seg is going to be helpful to to hit against my other passive income that's coming in.
Yeah. Oh, that's great. It's just an extra benefit.
And just for the listeners, I know we're talking about W-2. I used to be a W-2 as well, but for me personally, I'm looking at a legacy. I'm not looking. Real estate is not a quick scheme. You're not going to get rich overnight. I'm trying to build a portfolio so that when I'm 52 now, but once I hit, retirement, or even, I don't know what your definition of retirement is. I never want to stop.
Nick's retired right now, by the way. Aside from his real estate stuff right now, I know you do some other stuff beyond that, but but I don't, I just want to have that security that I know that the money's never going to stop coming in, and to build a legacy to leave to whoever, right? To the next generation, to the kids. And just, I don't want to be dependent on a paycheck or some company saying, sorry, thank you for your service, but don't let the door slap you in the ass. I hope this is not a PG call. I'm sure it's we're good. We're good.
Yeah, we're good. But yeah, and it's a long-term play. It's taken me years to get to where I am. This didn't just happen a year ago or 2 years. It's been years. I've been in real estate. I mean, I was exposed to it with my dad being a landlord and owning a duplex back when I was 18. So I helped him with that. And then, I started investing in those condominiums, and I started investing in those right after, actually the first one was in it was 2004, 2005, and it's taken me a while to grow it. But once you understand it and you see it and you see the fruits on the tree, it becomes easier and easier.
Yeah, it's kind of, it's real easy, I think, for people to understand, having a portion of their paycheck taken out to go into their 401k. It's something that you don't necessarily see, but you can do the same kind of thing for investing in this stuff by just taking, whatever paycheck you are getting, if you're W-2 or self-employed, doesn't matter, but whatever pay you have coming in, if you can allocate a piece of that off for your active investments, then you can do that. And once it builds up to the, 50,000, 100,000, whatever the buy-in is, now you've got another deal. And then those things just sit there and grow in the background. And then, when it comes time for either to be sold or refinance, you get your capital back. So
if I knew back then what I know today with the 401, I went full blown out on my 401 because that was one of the things I knew would decrease my tax liability.
Right.
But they're in control now, right? Like when I turn 70, they're going to force me. There's a formula that says you have to take out so much. They take what's in your account, multiply it by 70 and a half or whatever that number is, and say, well, you got to pull out, and then you're going to pay taxes. Well, I don't know who's going to be, what the tax rate's going to be in there. Now, I'm not a lawyer or a CPA to tell you what to do, but again, in my position, I didn't have anything when I started the 401, but you have to find out. I wouldn't want someone not to invest in 401 and pay more taxes. But if you do the math and someone walks you through it like a CPA, because everybody's situation is different, if you go and you buy an investment property and the government's taking, if you don't invest in your 401, you're going to pay $10,000 in tax. But if But if your rental income is bringing you in $15,000 or $20,000, right? You're building equity and you're building your portfolio. Then yeah, I'd go ahead and do it. But don't do it if you're going to pay an extra $12,000 in tax and you're only going to make $2,000, right? But again, you have to talk to a professional to walk you through it because everybody's situation is different. But if I knew now what I would not have invested in my 401. I would have put it in real estate right away. I wish, and you hear that from everybody. I wish I started way before when I did.
Exactly. Yeah, and I am diversified, but I think it's, I definitely am allocating more towards real estate now. Just to me, it makes sense. It's a tangible asset. A stock can go to zero. Bitcoin can go to zero. My record with Bitcoin ain't that great. So
mine either.
Yeah. I everybody was talking about it, so I went ahead and invested. Luckily, it was just a little play money, but anyway. Well, no, Nick, I appreciate it. We're getting kind of 45 minutes in here, and so I want to respect your time. But I do have just a couple more questions for you, if you have just a few more minutes. Sure. One thing, I guess, what advice would you give somebody, and gave a little bit of it just a minute ago, but what advice would you give somebody if they were starting out, when it comes to investing and real estate in general?
Figure out where you want to invest. And the first thing you want to figure out is you want to be passive or if you want to be active. Look, some people might love doing their job. There's doctors that I know that hate their job, and I know doctors that love their job. I know plumbers that love being a plumber, and make sure when you wake up every morning, you're passionate about what you're doing. And investing, sure, invest in the market, but be diversified. Educate yourself. Learn about the market. Learn about, when I say market, I mean learn about the stock market. Learn about real estate. Learn about the different types of real estate, right? You want to know, like, office. It's going through it's turmoil now, right? With offices right now. Learn about apartments. Learn about the different classes, and just find the group of people that are doing it. That's the key important thing, is find people that are doing it, and try to go up to their go to their meetings and ask them, hey, can I invest $10,000? I don't have $50,000 or $100,000. Can I invest whatever you got in cash, and that you don't need it? Start investing, because once you start investing and you start getting that return, and you're going to understand it much better when you're in it, versus just listening and hearing other people doing it. You're going to learn it. You're going to do your income taxes. You're going to see how that income and that investment, you're going to see losses right in the beginning if they do depreciation. Oh my God, it's offsetting some other income. So get into it as soon as you can, and find a mentor. Or find someone that's already doing it, and hopefully they'll mentor you.
Yeah, no, I think that's great advice. Anytime you can get a mentor is good. On that note, I know you've done different mentorships, different things. Are there any specific ones you would recommend, or any mastermind groups that you might recommend?
I'm not going to recommend any of what they call gurus out there.
Sure.
Because they're all different. Someone's going to have to do their own homework on that and decide how, if they want to go fast, then maybe you do that. I would recommend hitting a mastermind, and you don't have to go into a mastermind where it's like $10,000 a year. Again, depends on your situation. I'm sure there's plenty of masterminds, but someone that, we're both part of GoBundance, and that's a tremendous group. I'm in my third year and I love it, but I also, we're all participants and we all bring something to the table, right?
Right.
Someone that's 18 years old joining GoBundance, I don't know what kind of value they're going to bring to us, right? Because we don't just talk about business. We talk about our kids, our health, our everything, right? I think majority of the time, business is like the last thing we talk about. So, I mean, just hang out with people that do it, or start investing, and get yourself involved in somehow some kind of real estate mentor, meetups. Just hanging out with them and listening to the other people that have done it. You're going to learn from that too, right? Now, if you've got the finances, you're 20, 25 years old, and you've got the finances, then go ahead and you'll learn. It depends how fast you want to go and what kind of trajectory you're looking at. But the key thing is just hang out with people that do real estate, and find a mentor, someone that's going to take you under their wing.
Yeah, makes
Trust
a
me,
lot of sense.
There's plenty of people out there that will take, if anybody comes up to them and says, I want to learn it and I want to work in it, not that we'll do it for free, but I want to learn it. It's not hard to find someone that will take you under their wing.
For sure. No, that's great advice. I appreciate it. Last thing, any book recommendations? Anything you've read recently or listened to on Audible that you want to recommend to the?
I just downloaded on my Audible Napoleon Hill, Not Think or Grow Rich, How to Make Friends, or what's the one? It's all about relationships and stuff. I just downloaded that. I turned my phone off for this call, but
no problem.
There's a few out there. Who Not How, Dan Sullivan. That's a great one.
That is a great one.
Gain. I love reading his stuff
for sure.
Yeah. So those are the type of books, but there's I don't know. It's a hard one. I mean, I use the gap in the game every day, right? Who's my who?
I do too.
It's the who, not the how, right? So I try to figure out who's my who, and I also try to figure out who am I to who, right? So I bring value to someone else, and I try to find them too, to say, look, I'm your who. So,
yeah. Well,
you
certainly brought value to us here today. So we appreciate that, Nick. Thanks so much, and much success. Where can people learn a little bit more about you? Best way to connect.
Best place is LinkedIn. Just look up Nick Andromidas. I think I'm wearing a red shirt in the photo. Hit me up on there, DM me, connect. That's the best place. That's where I keep everything updated in there.
Awesome. All right, brother. Appreciate it.
Keith, thank you so much. All the best to you on this show. And I'm looking to, to your massive success with this, and keep going, because people need to hear the good word out there.
All right. Thank you, Nick. Appreciate you, man.
Take care. Thanks,
Take care.
Keith.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.